In the previous video, we looked at the American financial system in a nutshell. Today, let's dig deeper into the cause of the 2008 financial crisis. When a bank issues a loan, it has to set aside the reserve capital equivalent to the loan in case the loanee defaults. Banks normally borrow money from the Federal Reserve to create and issue loans at a commission, making awesome profits. These loans lock a lot of bank capital since, for instance, a typical mortgage loan lasts for 30 years. Institutional investors like the pension funds and the hedge funds are always sitting on large piles of money belonging to the public, and typically, they loan this money to the government through buying government bonds. The return they earn from lending to the government is dependent on the interest rates set by the Federal Reserve. After September 11, 2001, the Federal Open Market Committee recommended lowering the interest rates. This meant that banks could borrow at a lower interest rate from the Federal Reserve. To crank up the sale of loans, they unlocked a new market by figuring out how to set free the bank capital tied up in mortgages. They pooled those loans together with other loans held by the public, ranked them based on the risk of default, sliced them, and sold the loan portfolios in the stock market as a derivative financial product called collateralized debt obligation. The risky slices of CDO were insured through buying a credit default swap insurance, hence selling those risky CDOs as safe assets to the investors and freeing up the capital locked in the 30 years mortgage. The higher the mortgage interest rate, the higher the value of the CDO. This eventually led to the predatory lending practices where homeowners were tricked into taking unrealistically high or variable interest rate mortgages, which could reset when the Federal Reserve reviews the interest rate. The bankers did not care, since as soon as they converted the loans to CDOs and sold it to the investors, it became the other guy's problem. The money the banks earned was subdivided amongst the employees in form of bonuses. Since the CDOs were not regulated by the government, anyone could bet against the mortgage market by buying credit default swaps on securities they do not own. Goldman Sachs sold mortgages that were designed to default and bought credit default swaps on them. Imagine 5 people buying insurance premium on the same product. When that product fails, the insurance company will be on the hook for paying the 5 times the value of the product it insured. Goldman Sachs bought a lot of credit default swaps from AIG, that is an American insurance group, until they realized AIG will go bankrupt. Thus, they insured themselves against AIG potential collapse. AIG did not realize how risky the CDOs were. Thus, the employees subdivided the insurance premium money amongst themselves when the mortgages started defaulting. AIG did not have enough cash reserve to make settlement to the premium holders. That is why AIG had to be bailed out by the federal government at a tune of $180 billion when the mortgages started to default. If AIG was allowed to go bankrupt, airplanes could have to stop flying, since some airlines insured their planes with AIG. From the time the investment bank buys the pool of mortgages and other loans to the time they package them, those debts stay on their balance sheet, leaving the banks vulnerable since they bought them using borrowed money. The ratio of your money versus borrowed money is called the leverage. If you have $1 and you borrow $33, you have leveraged 33 to 1. If the product you are holding loses $5, your loss is 400%. This eats a big hole on your balance sheet, especially if you do not have cash reserve to offset the loss. This is what happened to the over-leveraged Lehman Brothers, an investment bank that collapsed during the crisis. They had to file Chapter 11 bankruptcy when the federal government declined to bail them out. This bankruptcy triggered panic. Trust within the banking community broke down, since no bank knew the status of the other bank's balance sheet. In the wake of Lehman Brothers' collapse, interbank lending was halted instantly. Credit, a lifeblood of American economy, was frozen. Lending stopped, and all of a sudden, companies like McDonald's, Ford, General Motors, among others, could not pay their employees. It's worth noting that over 95% of all financial settlements in the US are conducted through banks. Salary payments, sales and purchases, among others, are made with debit cards, credit cards, and checks. Therefore, you can imagine the devastation of freezing financial transactions to the economy. This is what caused the 2008 financial crisis. The crisis had a ripple effect throughout the whole world. It's sobering to know that even if you are a billionaire, all your billions are held by the bank. Regardless of whether you are the US president, a congressman, a Supreme Court judge, or an average Joe in the streets of New York, you depend on the banks for your day-to-day transactions. That is why I had mentioned in one of my previous videos that an American bank CEO is more powerful than the US president. During the 2008 financial crisis, it made sense to bail out the banks instead of the Americans who were foreclosed in order for the banks to unfreeze the credit market and start lending again. Instead of the banks lending the bailout money, they started buying back their stock, increasing the valuation, and the ordinary American was left in the cold. To understand the credit default swap derivative, you could bet on the future price of a product and buy some kind of insurance which would give you the option but not the obligation to buy or sell that product at a later date based on the current price. Your bet for or against a financial product would pay off if you are right. For instance, a bag of maize goes for 600 shillings during harvest. If the harvest is good, the price drops even further. If the harvest is not good, the price goes up substantially. You could buy a price guarantee insurance, a derivative, during planting season to protect yourself against large price fluctuations. Financial credit default swaps were designed such that you could buy insurance premium to a product that you do not own and get paid if you are right. Then skew the odds on your favor. Banks were lending over leveraged money to the public at a higher interest rate than they paid for in the Federal Reserve, making large profits. When everyone who had qualified for a mortgage had won, the bankers started issuing loans that were designed to fail, bought credit default swaps on them. You see, an insurance policy is the most highly regulated product in the financial market, such that if you underwrite a $300,000 insurance policy, you have to set aside $300,000 and ensure it's always available to settle a possible claim. Credit default swaps were insurance policies that were not designed to be regulated as insurance policy. Thus, an insurance company did not need to have the money to pay the policy they were underwriting. AIG did not have cash reserves to pay the insurance for mortgages they had already insured against the default through the credit default swap. So to understand the spreads, imagine a company with the product in the market reporting profit year after year. This company can forecast its value 5 to 10 years in the future and go public, raising capital to expand and ramp up its operation. To take a private business public, the business owner collects all the record related to business, including balance sheet showing assets and liabilities, contacts the investment banker, who, after reviewing the business track record, prepares the necessary paperwork and submits it to the Security and Exchange Commission, the SEC. The SEC reviews the paperwork and approves the investment bank to take the company public. After all the requirements are met, the investment banker works with the stockbroker, and issues the shares through initial public offer, the IPO, which are now traded in the stock market. The cost the investment banker charges to bring the IPO is called the spread. In the stock market, you can buy and hold the actual stock and hope its value will appreciate. When the company makes profit, the total net profit is subdivided by the total number of shares in the market and issued to the shareholders in form of dividends, which can be annually, semi-annually, or quarterly. You can bet on the future value of the stock based on its current value by trading options. If you bet the value will go up, there are options here in the US sold 100 shares at a time. If the current value is $10 and you can buy the right to buy the shares for $12 in the next 2 weeks. If the share price goes up to $15, you pay $12, and depending on the cost of the option chain, you make some profit. If the share price goes down, your option expires out of money. You will not pay $12 for a share that is now worth $6. Thus, you let the option expire. If you bet that the stock price will drop within the time the option is active, you buy puts. This way, you buy the right to sell the share at a specific price. If the price falls, you will still sell the share at the price you had selected. If the price goes up, you can only sell the price you had bet on. The value of call options goes up if the stock price goes up, and vice versa, while the value of the puts goes up as the value of the stock drop, and vice versa. Therefore, you buy calls hoping the value of the stock will go up, and buy puts hoping the value of stocks will go down. The value of stock is going up in a bull market and drops in a bear market. Therefore, you can make money both when the stock is going up or down if you make the right prediction. It's worth noting that loans are not taxed here in the United States. Capital gains are taxed when you sell your assets. Combining those two loopholes, leaders and owners of publicly traded companies normally have their compensation paid in form of stock, which can only be taxed when sold. They take a loan with the stock as the collateral for their own expenditure, effectively avoiding taxes. This is how rich people in America keep getting richer. Elon Musk bought Twitter and changed its name to X. To avoid antitrust lawsuit like the one Facebook is facing at the moment for having acquired Instagram and WhatsApp, he decided to make it a shadow company by selling it to his XAI company. But the proceeding was all in stocks, not actual cash. This means he cannot be taxed because he has not taken the actual cash. AI was not in the tax code, thus cannot be taxed, while other ordinary American is paying exorbitant amount of money to the government. Welcome to the 21st century financial wizardry.